The Treasury market is the most boring, but by far, the most important financial market in the world. In the news this week, we discussed the Treasury market's two economic wars and the Treasury market's toxic codependency. We also pay homage to one of the greatest artists of all time, Dolly Parton. Louie, I know you want me to talk about something much more exciting than the Treasury market, but I can't help myself. Scott Bessent, the Treasury Secretary, he wrote a piece. He wrote an op-ed piece, but of course he said this through other venues as well, and basically saying that we're engaging in the equivalent of economic war with Iran through the use of sanctions and the threat of sanctions. I want to take a deep dive into that, but also one of the bigger issues is that the Treasury has been buying long-term bonds. So they're issuing short-term bonds, which have a slightly lower interest rate, and they're using the proceeds to buy long-term bonds. And the idea is that they're trying to reduce the term spread. And the thinking is that, it'll help bring down mortgage rates a little bit and things like that. The problem is you have inflation running well over the Fed's 2% rate. And the bond market is increasingly believing that the Fed is going to have to raise rates somewhat. So I think a lot of very smart credit people are wondering whether the Treasury's efforts are going to collide with the Fed's attempt to tame inflation. Basically, if you're trying, even if you bend the longer term bond rates down a little bit, it's going to increase credit availability at a time when an increased credit availability is going to further fuel inflation. Does that make sense?
It does.
Now, we talked about this a little bit. Basically, what the new Fed Chair Kevin Warsh is doing is he is pulling back on the amount of communication that the Fed does and the amount of guidance that the Fed provides markets. He basically thinks markets should be in the driver's seat.
Okay.
And I understand and I appreciate that view. Every year, the Federal Reserve does a big symposium in Jackson Hole, Wyoming.
Mm-hmm.
The reason they do it in Jackson Hole, Wyoming goes back to Paul Volcker's days in the early 80s, because Paul Volcker was a fly fisher.
Okay.
And so they chose this. But they do this big symposium, and markets follow this very closely because a number of Fed officials give their views on things. And I think Kevin Warsh is going to be giving a speech on Friday. We're recording this on Wednesday. He's doing a speech on Friday at Jackson Hole. It's going to be widely followed. And because he has not been providing markets with the same kind of guidance and communication that the last few Fed chairs have done, the market is looking for any kind of communication they can get, any kind of, direction that they can get from Kevin Warsh and the Fed. So anyway, the idea is that what's going to happen when the Fed and the Treasury are at odds? The Treasury's been very interventionist. I can tell you right now, credit markets are not buying it. Bessent has not had a lot of luck bringing down long-term bond yields. The 10-year is still at 4.6, 4.7. 30-year bond yields are still over 5%. So I don't think he's going to be successful to begin with. Now, one thing that Scott Bessent and Fed Chair Kevin Warsh have in common is that they both shared a mentor in Stan Druckenmiller. Stan Druckenmiller was a hedge fund manager. He now just manages his own money. But one of those, when it comes to the macro economy, he's one of the voices that you want to listen to. And he actually put out an op-ed piece and readily admitted to using AI in writing the op-ed piece, by the way. But anyway, he put out an op-ed piece basically criticizing Scott Bessent's moves at the Treasury. So I think a lot of people are going to have strong opinions on this based on intention. And this is the point. This is why I think one of the things that we want to try to do with this show is to separate markets and market reality from the opinions that people have based on the intention of certain policies. I've said it before and I'll say it again. Markets don't react the way voters react. So right now, markets are not reacting favorably to what Scott Bessent is doing, regardless of what the intention is. And I know a lot of people want to see, if they have variable rate mortgages or they want new mortgages or they're borrowing on their credit cards or taking out car loans or whatever, we all want lower interest rates, but the only way to really bring that about is to bend down inflation expectations. So the question is, why do long-term bond rates spike over the last couple of weeks specifically? And the reason is inflation expectations, and they're not getting crazily out of hand, but they are ratcheting up a little bit. And one reason why is with long-term inflation expectations is that our deficits are as large as they've ever been. They're almost 6% of GDP. Outstanding gross national debt has exceeded the high that it was during World War II. Now, I want to bring something up since we like to get nostalgic on this show. You and I grew up in the Reagan era. Okay, and Reagan was accused of running these, huge deficits, and there was essentially when Bill Clinton came into office, long-term bond rates were relatively high, and so very famously, Clinton had to renege on a middle-class tax cut to focus on deficit reduction. And in hindsight, I think most astute economic commentators will look at that as the right move, because it did bring down long-term bond rates and it helped fuel the asset price boom and everything. And, the economy was booming in the 90s. Now, I bring that up because when Reagan left office, the gross federal debt outstanding was something like 43% of gross domestic product. It's 120% today. We always learned that, yes, the deficit was large, but it was nowhere near what it was during the Second World War.
Yep.
Now it's exceeded that in peacetime. Well, you can even take the Iran conflict out of it, but that's staggering. And my point is that this issue is not going away. It's not going to be an easy fix. Don't believe politicians of either side who think that there is some easy fix to this. Bond markets are not directly controlled by the Fed. So, firing somebody, putting in, it doesn't matter. Bond markets respond independently. And longer term bond yields that are higher than what we got used to after the financial crisis are probably going to be a permanent feature. Now, let me just say this to be more positive. Okay, Barron's had a piece this past week essentially asking the question, okay, when does this affect the stock market? Right? We all know that what's driving the stock market right now are AI stocks. So if you buy, if you're buying a broad index like the S&P 500 or the Dow, something that tracks those indices, you got a lot of most of that is coming from AI. I mean, Nvidia is like 8% of the S&P right now, one company. That's staggering. So we kind of know what's driving it, and you can argue that maybe it's not the barometer of the mainstream economy that it once was.
Yep.
The way it was when, you and I were in school and everything. But why are these higher interest rates not really, stocks are still rising. Why has there not been a major pullback? And one strategist said that the real barrier is 7%. If the 10-year gets to 7%, and I think we're a ways off of that.
Yeah.
So I guess that's the silver lining here. But I still see, I don't care what the Treasury does, and I don't like to make predictions, but I will just say, looking at the state of, the United States fiscal situation, and it's not just the U.S. A lot of advanced countries are carrying a massive amount of debt. When you add to that the massive amount of debt that is now going into AI data spending, and we don't know whether this stuff's going to pay off. Everyone, there was a piece recently kind of arguing that maybe the large language models were not going to be the economic boom that everyone thinks. Maybe it's the smaller language models that are sort of running on PCs.
Mm-hmm.
I don't know the answer to that, but I think it's. I will say I think markets are very nervous about that possibility as well.
You bring up one thing, um, you know, about the debt during, wartime, peacetime, things like that. I feel like we need to understand that wars have changed over what World War II was and how we are different weapons we are using.
Well, not only that, can you imagine? Like I don't know how many people in your family that you remember that just lived through that time, not even
Yep.
necessarily fought in the war, but just lived through that time. We don't appreciate that there was a national mobilization.
Yep.
Like just everybody was sacrificing something. Your whole life centered around
Mm-hmm.
the Allies winning the war. I cannot imagine that ever being the case. And I think not that not that you and I sort of weigh into foreign policy, but I got to think that that's always going to be a factor in terms of the limits of United States
Yeah.
military strength.
Well, and again, I think that we're using economics as warfare and
Good you
not,
say that because that's going to segue into my next
yeah.
discussion.
And I think that is something that we need to look at. And what does that look like for us on the street? You know.
Yeah, every day. So Scott Bessent, the Treasury Secretary, he wrote an op-ed piece last week that I saw in the Financial Times, but he also just uh, he announced this through different channels. Basically, they're going all in on using sanctions against Iran and against countries that do business in Iran. I think people looking at that don't understand that we've been engaging in this kind of warfare for a very long time.
Mm-hmm.
And what it really comes down to is that it was really after 9/11 when the Treasury realized that they had tools at their disposal to seize accounts and to engage in economic warfare against different countries and different players. Now, I was starting to do a really deep dive into international economics last year, and I had to
Mm-hmm.
put it aside. But two of the books, I even started a Substack and everything. I want to get back to that project, but two of the books that I was reading, one was called Choke Points, American Power in the Age of Economic Warfare. This is all about sanctions and specifically a lot of the sanctions that we were using against Russia and in other countries. And then there was another book that came out last year, really good book called King Dollar. It's from a journalist that's been following the international economy for a long time named Paul Bluestein. What King Dollar is about is how part of the US dollar's central role in the economy
Mm-hmm.
is that basically all international transactions have to come through the United States financial system in
Yes.
some way.
Yep.
And so uh, the U.S. has some tremendous levers that it can use, and particularly with the use of secondary sanctions. What
Mm-hmm.
secondary sanctions are is rather than just sanctioning the country itself, you can sanction anyone doing business with the country.
Yep. Yep.
And it's kind of a controversial thing. But the other side of it is because we've been doing it so long, countries have found a lot of loopholes to it and
Okay.
they've built alternative payment systems.
Mm-hmm.
So I'm just going to say the jury's still out as to how effective, because I think it's fair to say, and I hope this is not too controversial, we seem to be in a stalemate
Mm-hmm.
in Iran.
Yeah. Yeah. Yeah.
And the economic sanctions are nothing new. We've been doing that for a while. Maybe we're doing it to a larger extent now. I don't know.
Yeah.
There's not been a lot of details as to what the Treasury is going to do, but I just want to bring up the point that this is something that the United States has been doing for a very long time, and it comes down to something that we'll talk a lot more about, which is the role that the U.S. dollar plays in the international monetary system, going back to the end of the Second World War. But it gives the United States enormous leverage in being able to track virtually any major international capital flow comes through the U.S.
Yeah.
financial
Yeah.
system. So anyway, I just wanted to add to that because it's been something that I've been doing a deep dive in, um, and it's still it's still a big piece of news, but we've been doing it for a while.
Yeah. Absolutely.
The final thing on the Treasury market, this came out a week ago or so, a little more than a week. There's this great article that came out in the Financial Times. It's called "The Treasury Market's Toxic Codependency." So basically, when we think about outstanding U.S. Treasury debt, we think about foreign ownership,
Mm-hmm.
right? We're thinking about China owning all of this. We're thinking about, but actually, the biggest owner of Treasury securities are hedge funds. So I'm going to talk a little bit about the financial plumbing uh, during COVID. When COVID first started to hit, I know we criticized the government's response and everything, but even before any of that, markets started to break down well
Mm-hmm.
before there was any kind of real response. And I think that's something to keep in mind. What he's talking about, this author of this article, what he's talking about is what hedge funds do is they issue money in what's called the repo market. Okay,
Mm-hmm.
the repo market are literally overnight loans. Now, here's how the repo market works. Let's say I'm an institution and you're an institution. I sell you securities, like highly safe securities like treasuries,
Mm-hmm.
okay? And then I buy it back from you the next day at a slightly higher rate.
Okay.
So it's a loan for all intents and purposes, but it's technically a sale. So they call it a repurchase agreement, repo market. Huge market and hugely important market. So what hedge funds are doing is that they will borrow in the repo market, and they use this to uh, to buy treasury and particularly treasury futures. There's a small yield difference, so they're raising money in the repo market, and they're engaging in this interest rate differential between treasuries and treasury futures. Bottom line is they control well over 8% of the according to this, it's 8.5% of the entire market that hedge funds now control. The concern is that if this spigot of short-term capital dries up, you're going to have some major problems in the treasury market. And this is
Mm-hmm.
exactly what happened when COVID first hit. So this is really in March. The treasury market broke down. Not a lot of people remember this. So this is very different from, say, the financial crisis. What happened during the financial crisis is treasuries became a safe haven, right? So there was this huge influx demand for treasuries because no one wanted the commercial paper from banks, and no one
Mm-hmm.
wanted treasuries were ultra safe. When COVID hit, all anybody wanted was cash.
Mm-hmm.
So the point is that as this short term spigot of capital froze up and everybody wanted, there was no demand for treasuries, and this is where the Federal Reserve had to come in, and this is where their massive money printing was put into place. So you had this huge spike in the money supply. Um, can we really say now that's never going to happen again? And that's the question I'm going to throw out there, right? If this happens again, this is something that could be a problem. And yes, the Fed has tools, but there are always trade-offs. So the Fed,
Mm-hmm.
if they print a lot of money, they could buy whatever they want. but again, it's going to be inflationary.
Yeah.
And these are the things that keep me up at night, Louie.
Well, and I think one of the lessons that we learned from COVID is, you can't believe it happening, and yes, it could absolutely happen again. When, how,
Well, that's the question.
you know,
It's just like living in South Florida. We know there are going to be hurricanes,
yeah,
right? So you build a house. You don't build a house to withstand a hurricane because you know exactly when the hurricane is going to happen, or with what it's going to look like, and
yeah,
et cetera. You just build it to withstand hurricanes.
yeah, yeah,
And that's kind of how we have to look at our financial system. We don't know when the next crisis is going to
yeah,
happen. We don't know what it's going to look like. We don't know what the driver of that's going to
yeah,
be. We just know it's going to happen,
yep,
and we hope that our financial system, holds up.
yeah,
I'm not a gun and golds guy.
yeah,
I'm
yeah,
not, I'm
yeah,
not someone who, I don't personally. I don't know if gold is going to save you if there's ever a major, meltdown. I think human societies are. I think they are able to build economic systems organically and very quickly. It depends on how bad things are. If we're talking about like nuclear Armageddon, well, I think most of us are dead. So
yeah,
I'm not overly, I'm not overly worried about it.
yeah,
But my point is, I don't, even though I'm not a macro investor and I'm not a macro analyst, I still try to pay attention to what's going on in the world.
yeah.
I think about these little potential fractures to the global monetary system. Again, that's a product of you and I having lived through the Great Recession, the financial crisis, having lived through COVID. I think we have an appreciation that these things can happen and will
Yeah.
likely happen
Yeah.
in some capacity in the future. All right, Louie, our last news item, which is sad. Dolly Parton died at the age of 80. I'm not even a country music fan, but she was just such a big part of Americana.
Yeah, she was not only a singer, she was an actress, a philanthropist. She had a amusement park.
I started seeing in the stores. I think it's Duncan Hines, but she has her own line of like brownie mix and
Yeah,
all that
yeah.
stuff.
Well, and she just her last within the last couple years, she just created her own gas station to compete with Bucky's.
Oh wow,
Yeah,
yeah, incredible entrepreneur.
yeah,
But I tell you, music wise, what I'll always remember is the Christmas stuff she did with Kenny Rogers.
yeah.
That's like a staple thing I listen to every year.
I remember that 80 or that I think it was 80s movie or 90s movie, working 9 to 5.
Yes,
You know,
I have that song in my
yeah,
on my iPad
yeah.
playlist,
That is,
my iPhone rather.
she will be, she will be missed. We kind of last night we were like, wait, what's the world gonna be like without Dolly Parton?
I know.
You know,
Well, a lot of the news outlets were saying she could bring people together,
yeah,
and I think there are very few people who can do that, kind of bring people together regardless of where they're coming from politically, religiously, the whole thing. So yeah, we're definitely going to miss her. And with that, that's our news for the week. We talked a lot about the Treasury market. I know, again, I know it's not the most exciting thing, but the Treasury market is very important, and we are saying goodbye to an icon with Dolly Parton. So this is brought to you by the Fundamental Investing Institute. Go to fiilearn.com.